Friday wasn't a market correction. It was an execution. If you were looking at the red candles on your screen, watching the Chicago Mercantile Exchange, CME, the entity that controls the paper silver market, just pulled the kill switch. They quietly raised the margin requirements on silver contracts to 45%. Let me repeat that. 45%. Do you understand what that means? It means that if you want to bet on silver prices rising, you now have to put up nearly half the value of the contract in cash up front. They didn't fix the supply shortage. They didn't find new silver mines. They didn't solve the industrial deficit. They simply made it too expensive for the little guy to stay at the table. This is the oldest trick in the book. We saw it in 2011. We saw it in 1980. Whenever the price of silver threatens to break the banking cartel, whenever the short squeeze gets too hot for the insiders to handle, the exchange steps in and changes the rules of the game. They raise the down payment, the margin. This forces the leverage speculators, the hedge funds, the retail traders, the weak hands, to sell their positions immediately to cover the cash call. It triggers a forced liquidation cascade. They force you to sell, the price crashes, and then, miraculously, the banks step in and buy your contracts at a discount. You're being shaken out. The selling pressure you saw on Friday wasn't because investors suddenly decided silver is worthless. It was because the CME put a gun to the head of the futures market and demanded more cash than the traders had in their accounts. The analysts are already rolling out the narrative. You heard them in the intro. They are calling for a top. They are saying if silver breaks below $82, the bull run is over. They are quoting the gold to silver ratio dropping below 52 as a sign that silver is exhausted. This is a distraction. They are analyzing the paper price, a price that is currently being manipulated by a rule change. They are not analyzing the physical reality. Does a solar panel manufacturer care about margin requirements? No. They need the metal to build the panel. Does a missile defense contractor care about the CME rulebook? No. They need the metal to build the guidance system. The industrial floor is still there. The demand is inelastic. All the CME has done is create a temporary disconnect between the paper price, which they can control, and the physical price, which they cannot. They are trying to paint a double top on the chart to scare you into handing over your stack. And the weapon they are using to scare you is a ghost story from 40 years ago. They are screaming that this is the Hunt Brothers crash of 1980 all over again, but I'm going to show you why that historical comparison is a lie designed to make you sell at the bottom. Let's start by destroying the single biggest lie currently circulating in the financial media. You heard it in the clips we played earlier. You read it in the mainstream articles. Every time silver rallies, the establishment analysts dust off the same old ghost story. They scream, "This is the Hunt Brothers all over again. This is 1980. A crash is inevitable." They tell you that the current price action is a speculative bubble driven by greedy hoarders, just like when Nelson and William Hunt tried to corner the market 45 years ago. They tell you that because it crashed then, it must crash now. This is lazy analysis. It is intellectually dishonest, and it is designed to separate you from your position. Now let's look at the reality. In 1980, the silver market was driven by three men. The Hunt brothers and a small coalition of Arab investors were buying futures contracts with massive leverage. They were speculators. They didn't need the silver. They weren't building anything with it. They were playing a poker game with the Federal Reserve. When the exchange raised margins back then, they simply bankrupted three guys. The demand evaporated overnight because the demand was fake. It was purely financial. Now, look at 2026. Who are the Hunt brothers of today? Is it a couple of Texas oil tycoons trying to get rich? No. The whales buying silver today are not speculators. They are strategic industrial entities. They are the solar panel manufacturers in China who have just switched to N-type TOPCon cells, which use 50% more silver than the old panels. They are the electric vehicle giants who need silver for connectors and battery management systems. They are the defense contractors building guidance chips for the thousands of drones being deployed in global conflicts. And they are the AI data centers that require massive amounts of silver for high-efficiency conductors to prevent their servers from melting down. They tell you this is a speculative mania. The reality is, this is an industrial panic. You can margin call a speculator. You can tell a hedge fund manager, pay up or sell. But you cannot margin call a factory. You cannot tell a solar manufacturer, hey, the price is too high. Just stop building solar panels. They can't. They have government mandates to meet. They have supply chains to feed. They have factories that burn 10 million a day if they sit idle. Their demand is inelastic. They will pay 88. They will pay 100. They will pay 150 because the alternative is going out of business. So when the CME raises margins to 45%, do you think Samsung cares? Do you think the People's Liberation Army cares? Do you think Tesla cares? No. The only people who care are the retail traders using leverage. The margin hike flushes out the tourists. It does not stop the industrial machine. The 1980 parallel is a lie. The Hunts were betting on a price. The world in 2026 is betting on survival. To understand why Friday ES price drop was a manufactured event and not a real trend change, you have to understand the mechanics of the weapon they just used, the margin hike. Most people hear margin requirement and their eyes glaze over. Let's make it simple. Imagine you want to buy a house. Usually the bank asks for a 20% down payment. You put down $100,000 to control a $500,000 house. Now imagine the housing market gets too hot. The prices are rising too fast and the banks get scared. So, overnight, without warning, they change the rules. They say, effective immediately, the down payment is now 45%. And not just for new buyers, for you, the guy who already bought the house. Suddenly, you get a phone call. You need to come up with another $125,000 in cash by 5:00 p.m., or the bank will sell your house on the courthouse steps. What do? No, you don't have $125,000 lying around, so you have no choice. You panic, sell the house to get your equity out. Does that mean you hate the house? No. Does that mean the house is worthless? No. It means you were forced to liquidate. That is exactly what happened to the silver market on Friday. The CME raised the down payment to 45% for the January and February 2026 contracts. Thousands of traders who were long silver, who correctly predicted the price rise, woke up to a margin call. They didn't sell because they wanted to book profits. They sold because their broker threatened to liquidate their accounts. This creates a feedback loop of doom. The exchange raises margins. Leveraged traders are forced to sell. The heavy selling drives the price down from $93 to $88. As the price drops, other traders hit their stop-loss limits. More automatic selling happens. The price crashes further. The media looks at this and says, see, the market is rejecting the high price. The reality is, the market was mugged. The exchange created the selling pressure by changing the liquidity rules. But here is the secret they don't want you to know. This weapon has a flaw. It only works once. Once the weak hands, the leveraged speculators, are flushed out, who is left holding the contracts? The strong hands, the people paying cash, the institutions, the industrial buyers who don't use leverage. By flushing out the tourists, the CME has ironically created a much stronger, more resilient market foundation. The next rally won't be built on debt. It will be built on cash, and cash buyers don't get margin called. This brings us to the most critical concept you need to grasp for 2026. We are witnessing the beginning of the Great Divorce. The separation of the paper price from the physical price. The analyst in the intro said something very revealing. Did you catch it? He said, if the COMEX silver price ends below $82 per ounce, one can assume the silver price has made its top. This is the trap. He is telling you to look at the ticker symbol. He is telling you to look at the digital number on the screen. But what happens when the CME makes it impossible to trade paper silver? What happens when margins go to 50%, or 75%, or 100%? And yes, they can do that. If they make it impossible to buy paper silver, the paper price might indeed crash to $82, or $60, or zero. But does that mean you can walk into a coin shop and buy an American Silver Eagle for $82? Absolutely not. We're already seeing this fracture. While the spot price dropped 5.5% on Friday, did the premiums on physical coins drop? No. In many places, they went up. Why? Because the dealers know the truth. They know the vaults are empty. They know that 2025 was the 5th consecutive year of a structural supply deficit. We consumed 200 million more ounces than we mined last year. That metal came from above-ground stockpiles. Those stockpiles are now critically low. So the CME is playing a dangerous game. By smashing the paper price to $88 or $82, they are essentially putting a discount sticker on a Ferrari. They are telling the world that silver is cheap. But when you try to buy the Ferrari at the dealership, the dealer laughs and says, "That's the price for the poster of the car. The actual car is $150. This is the great divorce. We are heading toward a scenario where we have two prices. The COMEX price, 82, a fictitious number used by banks to settle cash bets. The street price, 120 plus, the actual cost to acquire physical metal for industry or investment. If you get shaken out of your position because the pound paper price hits a technical level of 82, you're handing your wealth over to the very people who rigged the chart. You're selling the car because the price of the poster went down. Don't be that person." There's one more layer to this margin hike that the mainstream experts are missing. They assume that higher margins only hurt the bulls, the buyers. But in a twisted way, this might actually be the death blow for the bears, the naked shorts. Think about it. The big banks, the ones who are short billions of ounces of paper silver, are also subject to margin rules. Yes, they have deeper pockets than you, but they are not infinite. If the price of silver turns around, if a geopolitical shock hits, or if the Fed cuts rates next month as expected, and the price spikes back to $95, the banks now have to post 45% collateral on their massive short positions. In the past, they could maintain a massive short position with very little cash. It was cheap to suppress the price. Now, the CME just made it expensive to suppress the price. They raised the cost of doing business for everyone, including the manipulators. If the industrial floor holds, if Samsung and Tesla keep buying, and the price grinds higher despite the margin hike, the banks are going to face a liquidity crisis of their own. They will be forced to cover their shorts, not because they want to, but because the new 45% rule drains their capital reserves too fast. This is the boomerang effect. The weapon they threw at the speculators is going to come back and hit them in the face. So when they tell you that the government is in a mood to control prices, understand what that really means. It means they are terrified. You don't change the rules of the game when you are winning. You change the rules when you are losing. The margin hike is not a sign of strength. It is a confession of weakness. It is the CME admitting that the standard mechanisms of price discovery have failed, and they have to resort to brute force to stop the breakout. Now, let's address the second biggest argument the bears are using to scare you. The analyst in the report pointed to the gold to silver ratio. He said, "The ratio has slipped below 52, which signals buying in gold is more favorable than silver. As most metals have stalled, silver may top out soon." This sounds sophisticated, it sounds prudent, but it completely misinterprets what a falling ratio actually means in a monetary crisis. The gold-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, when this ratio drops, it means silver is outperforming gold. The analyst looks at 52 and says, "It's too low, it has to go back up." This is normalcy bias. He is assuming we are in a normal market cycle where the ratio oscillates gently between 80 and 50. But we are not in a normal market. We are in a currency debasement event. Look at history. In 1980, during the peak of the inflation crisis, the ratio didn't stop at 52. It went to 17.1. In 2011, during the dollar crisis, it went to 30.1. Geologically, there is roughly 15 times more silver in the ground than gold. So a ratio of 52 is not expensive silver. It is still historically cheap silver. When the ratio crashes from 80 down to 50, it isn't a signal to sell. It is a signal that the slingshot has been released. Gold usually leads the rally. It moves first, stretching the rubber band. Then silver snaps back. It catches up violently. We are in the snapback phase. To sell your silver now because the ratio hit 52 is like getting off a rocket ship just because it cleared the launch tower. You're missing the journey to the moon. Finally, we have to talk about that specific number they keep mentioning, $80. The experts are telling you, if the price breaks below 82, the trend is broken. The bull run is over. Sell everything. Why $82? Is there a magical wall of silver at $80? No, it is a psychological anchor. The banks and the high-frequency trading algorithms know that thousands of retail traders have placed their stop-loss orders right below 82. They know that if they can push the price down to 81.90, it will trigger a cascade of automatic sell orders. This provides the massive liquidity the banks need to cover their shorts. They aren't warning you about $82 to protect you. They are guiding you to the slaughterhouse. This is called running the stops. They use the margin hike to create selling pressure. They push the price down to the key technical level. They trigger your stop loss. You get sold out of your position at the bottom. And then, once the weak hands are gone, the price miraculously reverses and shoots back up to $95. We also have to look at the macro context they are ignoring. The expert admitted that improved U.S. unemployment data and the Fed rate cut buzz are driving the dollar. But wait, if the Fed cuts rates next month, that is bullish for silver. Lower interest rates mean a weaker dollar. A weaker dollar means higher metal prices. So the fundamental driver, Fed rate cuts, contradicts the technical breakdown, 82. They tell you the chart looks bearish. The reality is the macroeconomy is screaming bullish. You have a choice. Do you trade the line on the chart that the banks are manipulating? Or do you trade the fundamental reality that the U.S. government is broke, the Fed is about to cut rates, and the solar industry is running out of metal? We have arrived at the conclusion. We have dismantled the 1980 lie, proving that today's buyers are not three brothers in Texas, but thousands of factories in China. We have exposed the margin trap, showing how the CME raised the down payment to 45% to force a liquidation of the weak hands. We have analyzed the Great Divorce, the inevitable split between the manipulated paper price and the scarcity-driven physical price. And we have revealed the $82 stop loss hunt, a manufactured target designed to steal your position right before the Fed cuts rates. The verdict is clear. The crash you are hearing about is not a market phenomenon. It is an administrative weapon. The powers that be are losing control of the physical inventory. They cannot print more silver. They cannot dig it up fast enough. So they have resorted to the only tool they have left, paper suppression. They are trying to break your will. They want you to look at a 5% drop and feel fear. But the smart money, the industrial whales, they look at a 5% drop and see a subsidy. They see a chance to buy the most critical metal on Earth at a discount, courtesy of the Chicago Mercantile Exchange. So, what do you do when the rules of the game are changed against you? Here's your battle plan. Step 1, ignore the paper price. If silver drops to $80 on the screen, do not panic. Ask yourself one question. Can I buy a coin for 80 tau? If the answer is no, if the dealers are still charging 100, then the screen price is a lie. Do not sell your real asset because a fake number went down. Step 2, watch the premiums. This is your true signal. If the spot price crashes, but the premium, the extra cost to buy physical spikes, that is the market screaming that the vault is empty. That is the buy signal. When the paper price disconnects from reality, you buy the physical reality. Step 3, hold the line. Understand that this margin hike hurts the banks just as much as it hurts the speculators. The higher the margin, the more expensive it is for them to maintain their short positions. Time is on your side. The industrial demand burns 3 million ounces every single day. The margin hike didn't stop that fire. It just hid the smoke for a few days. I want to leave you with this. There is a reason they are working so hard to scare you. You don't deploy a kill switch for an asset that is worthless. You don't raise margins to 45% for an asset that nobody wants. You only do that when you are terrified of the price going higher. They are lowering the price of the receipt because they are desperate to steal the car. Don't give them the keys. The financial media will keep reading the CME press releases. They will tell you the crash is here. They are the mouthpiece of the paper system. We are the voice of the physical reality. If you want to survive the great divorce, if you want to stand with the few who understand the difference between a contract and a commodity, then you know what to do. Join us, subscribe, and turn on notifications. Because the next time they pull the kill switch, you won't be a victim. You'll be waiting. Hold your stack. Ignore the noise, and I'll see you on the other side.